In the few months before the financial crisis, initial jobless claims in the US began to trend higher. This was one of the early signs that the US economy was entering a recession. We saw the same thing happen in 2000, a few months before the onset of the 2001 recession, and again in 1989, right before the 1990 recession began. Rising initial jobless claims is something that we've seen before every single recession in US history. And today, just over the last few months, we've begun to see initial jobless claims trend higher. The US has gone from 190,000 jobless claims in January, one of the lowest levels in history, climbing to 240,000 jobless claims, a 20% increase in just a few short months. Now, as you can see, there are moments in history where initial claims can rise a little bit and never actually lead to a recession. So let's try to figure out if this is just another one of these false signals, or if the recent rise in initial jobless claims is going to have momentum, potentially marking the onset of an economic downturn in the US, and what this all means for investors in the stock market today. Because if initial jobless claims are set to rise substantially from here, that really doesn't bode well for the stock market. Just looking back through history, we can see that every single time that initial jobless claims have risen in the US, that has coincided with a substantial move down in the stock market. The only exception we have to that is 1979, where initial jobless claims were rising and the S&P 500 actually stayed flat during that period. But in every single other instance, the stock market dropped by at least 20% and as much as 60% in the more severe cases. Unfortunately, we do have pretty solid evidence that this is the likely direction that we're heading in. The number of people that are finding jobs plentiful in the economy has been declining quite severely over the last year. This is something that typically happens in the year or so before almost every single recession we've seen over the last 40 years. And we've also started to see the number of people saying that jobs are hard to find rising, which is also something that typically happens before recessions. When we look at the yield curve, a notorious recession signal, we know that it's been inverted for the longest period of time since 1929. This is a signal that flawlessly predicted every downturn in recent financial history, and it's an incredibly accurate reflection of the state of the labor market. When the yield curve goes down, what's called a flattening, that's associated with periods where the labor market is strengthening and where initial jobless claims are moving lower. And after yield curve inversions, which you see right here, the yield curve goes up, what's called a steepening, and that's typically associated with a weakening labor market where initial jobless claims are rising. So with the yield curve inverted today for the longest period of time since 1929, our bias is heavily skewed towards initial claims rising substantially over the next few months. So is a recession guaranteed to begin now, with unemployment levels beginning to rise in the US imminently? Unfortunately, it's not that simple. We can see more recently that the yield curve hasn't actually been steepening and flashing a recession warning signal like it usually does heading into a recession, despite the recent rise in initial jobless claims. Now, this is actually nothing unusual. We saw this happen in the last 3 recessions, where the yield curve stayed flat, despite the fact that initial jobless claims were rising during those periods. These are brief periods of time where people are actually losing their jobs, but financial markets are not yet pricing in a full-blown recession. There's a disconnect between the economy and financial markets, and this is the early phase before a downturn. That's where we believe we are right now. And in this phase, where financial markets are not yet pricing a recession, the stock market is still typically rising. This is what happened between January 2006 and October of 2007, where initial jobless claims were rising, and the S&P 500 actually moved up by 30% during that period. This also happened between October of 1988 and January of 1990, where initial jobless claims were rising aggressively, but the S&P 500 rallied for a 30% move higher during that period, before eventually the recession started and the market dropped by 20%. And that's so far exactly what's been happening since January of 2024. We've seen initial claims rise and the stock market rise by around 15% since then. In 2007, this phase lasted about 300 days, where initial claims were rising with a rising stock market. In 1989, it lasted around 260 days before the stock market peaked. Today, we've had this phenomenon occur for the last 170 days. So if we're following the footsteps of the 2007 or 1989 recessions, we could still see a rising stock market with rising initial claims for another 100 days or around 3 months. This is why we're still looking to ride this bull market at least for the next couple of months, because whether we like it or not, this is an incredibly strong uptrend trend, and another 3 months of the same price action could take the S&P 500 considerably higher. We recently locked in a 10% gain on our tech trade, a 15% gain on Bitcoin, a 15% gain on ELF, and all of these positions are still riding higher. We update our members whenever we make any changes to the trades or whenever we add new ones. For example, we recently added Solana that we think can have as much as a 50% gain from here. If you want to have access to all of our trades, make sure to subscribe to our service.